All right, welcome to today's video. We're going to cover the handful of headwinds that the AI trade is facing right now. And again, this is not entirely my view. This is part of my study, but it's also coming from Jim Covello at Goldman Sachs. And essentially, the idea is that the AI trade was never about chips to begin with. The AI trade essentially was the promise that they were going to deliver record revenues and profits and disruption in the B2C space. That failed, and then they moved on to the B2B space. That failed, and now the entire narrative is about technology and job disruption. We're not seeing that yet, and I think that the winners are moving away from the technology companies that should benefit, the AI models that should benefit, and now it's all about chips, right? It's about semiconductors, it's about data centers, it's about memory. And this isn't the first time that the industry sees such an influx of demand. And before we get started, I want to share a quick clip that I put together on 2007, specifically the demand for memory flash cards that hit SanDisk and how all of that ended up. Let's get into it.
Mitch, music's 2 years ago. Everybody's got it. You know what everybody wants? Video on their cell phone. Now, if you know anything about memory, which it sounds like you do, you know that a video clip takes 10 times the amount of memory as a single piece of music, okay? Thus, again, over the next couple months, when these new handsets coming out, we're creating a tremendous market, a huge demand for flash-based memory. Can you see this?
Thus, we've just created this tremendous demand for more flash memory going forward. And again, Ken, who's the number one producer of flash memory cards? Exactly.
Do you have any idea how much YouTube did last year in revenues? $0.
They didn't make any money. So let me ask you a question. Tony, why would Google run out and pay that much money for a company that's not making any money at all?
Well, they did it because they're an advertising company.
YouTube is getting 100 million hits a day.
100 million hits a day. I mean, why?
Because we're voyeurs. We like watching other people.
All right, songs are out these days. The kids want video clips. Ow, video clips.
And again, SanDisk, they're the number one producer of flash memory cards.
There's no point in even watching it right now. Markets still decide what they want to do with the stock.
It's a little bit down from the close, but I mean, hit the ball of the park as far as the numbers are concerned.
Right now, it's battling.
Just go bonkers one time. 51, come on.
Here we go. There it is, 51 bucks.
51?
Yep, let's go.
Come on.
The number's been out about 25 minutes now. Market's had a little bit of time to digest it. Stock is trading higher. It is a good number. I'm a little bit disappointed that the market isn't appreciating the fact that they beat the street by north of 20 cents. Definitely thought we saw a better reaction on that.
Getting no respect right now. I mean, company comes out and blows away the number, clobbers the number, knocks the cover off the ball. And, you know, we're only up about 50 cents from the close, so that's a little bit disappointing right now. Cross our fingers, and tomorrow, you know, maybe we're up a couple more bucks. Company reported great news, and we had a bad result. What I mean by that is, Eli Harari, the CEO, came out and said, guys, listen, we've got more demand than we can meet. We can't even meet all our demand for the fourth quarter.
The stock pulled back a couple dollars that night, but nothing major. Right, so what you've seen is they've traded down recently. Friday we come in, and coincidentally, it was the 20th anniversary of the big market crash. 1987, October, there's a huge market crash.
It only added fuel to the fire, threw some kerosene on it. SanDisk was down 7.5 bucks.
Wall Street can certainly be a superstitious bunch. The guys I talked to, there's definitely some hard feelings that they didn't want to buy stock Friday morning, and apparently no one was buying SanDisk Friday morning either. What you'll find today is you get the stock on sale.
Short-term turbulation right here, but
Down, and SanDisk is down.
SanDisk is the majority of our book. Seeing their stock down 20, 30, 40% scares a lot of clients.
All right, so as you saw on the previous clip, everything progressed in the SanDisk trade from a very good idea, right? You had the 100 million hits a day on YouTube. You had the influx of record demand for memory flash cards. And essentially the stock price was booming right alongside the story. Everything looked beautiful. Everything was set up for a massive run. And then what happened? They reported earnings. Even though they outperformed or beat the expectations by over 30%, the stock barely moved, and in the coming months, it lost over 50% of its market cap. This happens because the embedded stock price requires too aggressive of an expectation to be fulfilled in order to justify even higher prices. So even after a beat on revenue and earnings, the stock failed to keep going higher because even after beating, the expectations were already too high. And that's what I want to focus on in today's topic. Instead of focusing on demand, try to project supply and look at where supply is coming from. As more hyperscalers and as more memory players start to flood the market with more supply, whether it is for data centers, computing power, AI models, and chips, what happens to the equation, right? The economic law of demand and supply. That's essentially what happened to SanDisk. That's essentially what's happening to SK Hynix, to Micron, and other players in the space today. Now, that being said, let's get into the bull break, the bull case breaking, and how the trade in AI gets a lot simpler. So first of all, the break. There's one clean AI trade that has broken out into separate bets, and that is in the hyperscalers. So the hyperscalers broke away from the semis, and while that always happens in every single cycle, today's break is different because of CapEx. CapEx wasn't present in previous breaks, and we're going to get into that. Now, the second point is the teardown. So Goldman Sachs Jim Covello laid out 5 simple reasons as to why the returns on these investments, the $1 trillion CapEx investments, may never show up. This is the enterprise revenue gap, the lack of technology disruption, the circular financing, and the fact that we're in an earnings bubble. Now, the insight that we're going to derive from all this is that the AI trade, let's get it into perspective. It was never about chips. It was about enterprise return on investment, CapEx return on investment, and technology disruption. We're not seeing any of that today. The trade, at the end of the day, is going to be found in the software space and select hyperscalers. I've said it before, and we're going to cover it all again today. Now, the break between hyperscalers and semiconductors, I mean, this happens every single cycle, right? And hyperscalers, when they lead the break, is essentially defensive, since these are massive free cash flow companies and generators and highly embedded entities in the US economy, while semiconductors and memory are more cyclical, right? And anyone that tells you that chips are not cyclical anymore is, I don't want to make too bad of an insult, but you already know what I'm thinking. I mean, they're a commodity. Commodities are cyclical. Whenever you have fluctuation in demand and supply, and there's not recurring revenue, but revenue is made from sales, from contracts, from delivering units, it's always going to be cyclical. I mean, don't even listen to what these crazies are saying, right? So the break currently is led by semiconductors. Why? Because all of the free cash flow in hyperscalers has been blown out. So the market wants to see today what free cash flow is coming in, what type of earnings are coming in, rather than a future promise on returning investment from these CapEx expenditures, right? So essentially, we are at the top of the capital cycle, meaning there's so much overinvestment going on and there's so much uncertainty about future demand and monetization from that investment that the market is punishing the companies investing into AI and are rather rewarding the ones providing the AI narrative, the AI supply, right? All of that is going to end up in a very bad way. And the first crack is already starting to show in the data centers. So data centers were essentially the biggest bottleneck that everybody sold us on, apart from energy, right? And memory chips and semiconductor chips and everything else. But right now, data center construction has gone from roughly 20 to 21% annual growth down to below 5%. I mean, 5% or less data center growth is going to have a major impact on future metals, on future materials, industrials demand, which is why I think you see the stocks like Caterpillar selling off. You see stocks like Constellation Energy. You see stocks like Vestra and all of these selling off because of the lack of future construction growth in data centers. Now, you have to ask the question, why is the growth coming off for data centers? I thought the AI demand was unstoppable. Now, if you have a 20% growth year on year for 2, 3 consecutive years, how much supply of data centers is coming in really? And how many projects are currently being built that are going to come online in the next 3 to 6 months? People are not thinking about this. They're all thinking about the demand side. And when you think about all the data centers that are coming in, it's going to get a lot crazier than it is today in terms of margin, pricing power, and essentially earnings. Now, here's one of Covello's first point. And it's not about whether AI works. It's who actually wins in the new AI world and the new AI economy. And he has 5 talking points, right? So first is the return uncertainty on the big spenders or the hyperscalers. The second is the enterprise revenue gap, which is the real bottleneck. Forget about materials, forget about chips, forget about HBM. That doesn't matter. The real bottleneck is revenue. If AI cannot command the revenue that it promises, who is going to keep investing into it, right? There's no return. So in my view, enterprise software, enterprise revenue is the only bridge that needs to be built in order for AI to keep paying. Otherwise, B2B, B2C is not going to get it done. You and I mean, I spent over $500, close to $1,000 a month on AI for research, for modeling, for everything else. But I mean, these companies have racked up over $3 trillion in commitments. Even if half the world's population pays for AI, it's not going to get it done. It's not going to close that gap. It has to be enterprise. Now, the third point is that workers aren't being replaced. That kills the entire math behind the economics of AI. And fourth is the circular financing. We covered all of this in a deep dive within the Offside newsletter. So make sure you give it a look. It all stems from NVIDIA and over 300 entities that are pretty much breaking the entire system. And then fifth and last is we're not in a valuation bubble. We are in an earnings bubble. And I've covered this before for Amazon, Google, NVIDIA, SMCI, and other names that have been getting punished. Now, the first point, we have over $1.3 trillion of projected revenue versus $5 trillion of commitments. And this is a Bloomberg study. You can see it there. By 2032, revenues from AI are expected to be $1.3 trillion. Now, this is a 5-time gap that we have currently. And this is even if revenue fills on that 1.3 trillion by 2032. Currently, these models are missing on 2026 targets for revenue, targets for adoption. So I think that those expectations may have to be revised lower. And this is the problem when you focus too much on forecasting demand rather than forecasting supply. Because right now you have Chinese models providing way cheaper AI usage at just about the same power and service quality, if you will, right? So if that affects these projections, that gap from revenue to commitments might even get bigger, right? Amazon blinked currently because they announced they're doing one last financing round through the bond market to raise $25 billion to go into CapEx, right? They also said this is the last round for 2026 and 2027 has not been announced or guided for. So now we're entering into earnings season. And if that kicks into the guidance or any of the language in the earnings, this might be the first sign of a CapEx slowdown due to the fact that these projections are not going to be met. The commitments are getting built way too much. And companies like Oracle that bet the entire company on OpenAI making good on those commitments are not seeing the money back, and the stock is crashing because of it. Now, the second point is replacing the workers, replacing jobs. And as of right now, this is a study by Section, is an AI consulting firm. Only 18% of workers have implemented AI in the workflow. That's nothing, guys. Like, this is only the US as well, where essentially the promise was that finance, insurance, consulting, lawyers, medicine, like every single job area was supposed to be disrupted or replaced by AI. And it's not happening. This is like 3 years now into the AI trade, and only 18% of workers have implemented AI into the workflows. And then you have the C-suite versus the worker gap. And you can see it in the respondent percentages, right? There's a big gap, about 40 percentage points, like 30 to 47 is the range here, of disagreement between the executives pushing for AI and the workers actually using the AI. And you can see it in the recent decision by Uber, right? So Uber tried to implement the AI. They blew out the AI budget in a single quarter. And the workers were saying, well, we have leadership boards to see who uses AI the most. And they were using it to predict tomorrow's weather and sort of get the news for the day. So nothing to do with actual workflows, which is why only 18% of workers have implemented it successfully. Now, the third point is every winning tech killed a leader. AI has killed nobody. So in history, whenever you have a new piece of technology, in order for it to succeed, it has to replace or disrupt an old technology. You had the internet replacing things like yellow pages, like newspapers, like, mail, right? You had Netflix and streaming replacing Blockbuster. You had Google replacing newspaper advertising. You had Amazon replacing brick and mortar, right? AI is not replacing anything, and the data shows it. I don't care what the story is. I don't care what people are telling you. Look at the data. Right now, the most exposed industries like engineering, consumer services, sales, back office, they're not getting replaced. I mean, look at this chart, right? Less than 20% of job functions that should be replaced by AI are getting replaced. This matters because if you study the timeline in AI, it went from we're gonna beat out everything in B2B. That didn't work. Well, we're gonna go down to B2C. That didn't work. Now, the only narrative is we're gonna replace jobs and disrupt existing technologies. That's not working. So I think at the end of the day, AI is gonna become a productivity enhancer, such as the internet, such as any other piece of software, right? Like accountants used Excel to become more productive. That doesn't mean that Excel is gonna replace accountants. Same thing as I think is happening with AI. It's only becoming a productivity enhancer. It's not going to replace the jobs, as the data shows 3 years into the trade. Now, the fourth point is the circular financing, right? Back in the day, this used to be called vendor financing, which is essentially suppliers are financing their customers so that they buy supplies from them, right? So at the end of the day, if NVIDIA finances a customer like SMCI with $1 million, and that same $1 million comes back as sales, as booked revenue, no actual cash was made. It was all accruals, and you're starting to see the difference between reported net income and cash from operations. Every single fraud in the history of finance has come from widening divergences between net income and cash from operations, right? You could look at Enron, you could look at WorldCom, you could look at Cisco, you could look at a bunch of companies, and whenever that divergence, that spread widens by a lot, it essentially blows up. And right now, NVIDIA has over $60 billion of accruals, which means reported earnings that are not actual cash. When that crashes, nobody knows, but it's essentially a big red flag. And I think one of the reasons why NVIDIA has been lagging everyone else in the tech sector and the semiconductor space and everything else. Now, the reckoning is that under GAAP, which is generally accepted accounting principles, those earnings have to be adjusted at some point. When that happens, we could see Amazon, Google, NVIDIA, SMCI, Micron, SK Hynix, all of these earnings get slashed in half. Right, so what happens to the stock price? What happens to the stock market? That's the big question here. The fifth point, stemming from those earnings shenanigans, is that we're not in a price bubble, because if you look at earnings multiples, right, like PE, forward PE, PEG ratios, I mean, everybody's talking about Micron's cheap earnings multiple. Everybody's talking about the fact that NVIDIA has a cheaper earnings multiple today than it had a year ago. And sure, that's all nice and perfect, but when you look at the underlying earnings and you figure out that less than 50% of what was reported was actual cash and the other 50% was accruals, what happens when you adjust these earnings according to the rules, according to the law, right? Well, those earnings get slashed in half and the multiples essentially double or triple, which means we are in an earnings bubble, not a price bubble. So Covello makes a great point, splitting between public markets and private markets. So in the public markets, we have the earnings bubble where the EPS need to be adjusted. We have real multiples being double or triple what's actually being reported, and the company's exposed. If you look deeper, there are a bunch of them, but so far you can see it in Nvidia, Google, Amazon, Oracle, and a bunch of others, right? On the private markets, that's where we have more of a pricing and valuation bubble, with OpenAI and Anthropic reaching $1.5 trillion each. You have the SpaceX IPO, you have the Skydex. You have the SK Hynix listing in the US, right? So all this new supply is coming in at sky high valuations. What that means is, well, these companies, if we believe the story that AI is just going to become a software that enhances productivity, I mean, why isn't Microsoft worth over $1 trillion, right? Or $5 trillion, or whatever the number is? Well, because they're not going to be exposed to the AI narrative. And the AI narrative is going to slowly pop as people realize this is just going to be a productivity enhancer rather than a disruptor, because it hasn't disrupted anything. Now, the synthesis here. The AI trade, again, was never about the chips. So why are the chips winning, right? It's all about demand. Demand, HBM, memory, and all this and all that. Look, it's not happening, guys. So you have to look at the other side of the equation, which is supply. And if you watch the SanDisk video that I made for you, this essentially is the same thing happening. I mean, SanDisk reported that they won't be able to meet demand, and the stock went down 50%. Why? Because everyone else sees the same story. Everyone else sees, well, SanDisk is reporting record earnings, Micron is reporting record earnings. So that's a business we have to get into because all the money is there. As more entrants get into the industry, more supply comes in. As more supply comes in, less margin and pricing power is the result, and then earnings power goes down the drains. Now, we have all these tenants slowing down, right? We have CapEx is starting to slow. Data center construction is slowing. We have chips being in a circular financing mode, and essentially no cash is being made. No inventory is getting moved. The AI models are not getting adopted. The AI models are not disrupting anything. They're only enhancing productivity. And then you have software. This is where the entire money lands. And I've been proven right so far in the price action for IGV, Adobe, Workday, Microsoft, and you name it, right? They're roughly 10 to 30% off of the 52-week lows, which is the same thing that happens when you have a correction in a bear market, right? You flip that on its head. Now we're having a positive correction and a bull market renewal on these names. And there's a reason why. The reason is everything that's happening before it. CapEx, chips, AI models, all of that is bringing a renewed interest and a renewed bull market for the software. Now, the AI will kill software narrative is dying in real time. And everybody, well, not everybody, but smart money, if you want to call it that, options traders are betting on that outcome. You have the IGV software ETF seeing massive inflows of options volume and options call options being traded for the upside, right? So you have over 1,095 strike July expiration calls going into the IGV. 110 calls hold the most open interest. So that is a bullish call spread. What happens is, well, 95 becomes the base case and 110 becomes a bull case, all happening by July, right? So something needs to happen in July for this to play out. And I think it's going to be the risk-off rotation, whether it is the renewed Iran war strikes, whether it is the SK Hynix listing, whether it is earnings season, something's going to happen, guys. Because as I've covered before, for every $1 that goes long the semiconductor and the memory trade, probably 30 cents goes short to hedge that trade in the software space. So if the memory and semiconductor trade goes down, then what happens is all of these short traders need to cover their shorts. creating demand and buying the pressure for the software space. So I think these traders may be right, and I'd be pushing for that 95 to 110 price target by the end of the month in July for software, specifically the software ETF IGV. Of course, the offside portfolio is overweight software if you read the morning digest, and we've been outperforming the S&P by over 5% this month. So, I mean, we must be doing something right. Now, this is where we reiterate everything. We're overweight the AI. I mean, we're overweight the software that AI can't kill, right? So we have names that show zero disruption, ROI adjacent, and risk off beneficiary, right? So zero disruption, meaning companies like Adobe, right? I did a whole deep dive on Adobe. I'll link it down in the description, where we show that the margins are not getting disrupted. The subscription growth is not getting disrupted. AI revenue, in fact, has tripled over the past quarter. Margins are steady. So this is not a company that's getting disrupted. This is a company that is thriving in a new world of AI. Now, the risk of benefit is that if we do have that rotation outside of the AI trade, these are the companies that are going to show over 100% upside, because the only reason that they're being kept lower is because of the narrative that AI will kill software, and that hasn't played out yet. And it isn't playing out if you look at the numbers. And the second reason is that they're being shorted to hedge out the longs, which are massive, right? So when you have that rotation, I think these names deliver over 100% upside. Now, you have the thesis, right? You have the setup, you have the headwinds, you have every piece of data and evidence that I've just shown you. And I don't see many of the bulls in the AI trade giving you anything other than a story. AI demand, AI replacement, AI this, AI that. I mean, I had a guy tell their clients that Caterpillar is becoming an AI company because they're going to use AI to make better tractors. What, right? Like this is getting to a level of insanity that I haven't seen since, I haven't been in the markets for that long. Been in it since 2016, but I remember the marijuana stocks, right? It's going to get legalized, is this, and then all that, and the story, right? There's no numbers. It's all about a story, and that's what I'm hearing about the AI from the bulls right now. Now, you're getting the breakdowns, you're getting the Covello points from Goldman Sachs, you're getting the ROI, you're getting the reality of the AI trade. Behind the paywall, in offside premium, and remember, prices are going up on July 17th from $59.99 a month to $249.99 a month. Why would I 5x my prices? Because of demand. Everyone's coming in, paying, and reporting that they have already paid for a year's worth of membership with one trade idea, such as the South Korean put options, such as the Lululemon on holdings spread trade, such as everything that I've been pitching you guys. So due to that demand, due to the quality of the research that we provide, I am raising my prices by 5x. And this is the first of many hikes. So I would suggest you sign up now, lock in your prices. You'll be grandfathered in at $59.99. Now, behind that paywall, you're going to get the live portfolio weights and updates, the entry targets, the exit targets, the hedging through options, through shorting in a simplified way that anyone can just double click on something and do it. And again, you have a 3-part deep dive on the AI trade as well. So everything that I covered, every single headwind, every single 5 of the talking points, I cover in a deep, deep way with all the evidence that the bulls are not giving you. So again, a lot to talk about here, but I hope you got the idea so far and how this evidence is much stronger than what anybody is providing today. Now, the coming days are going to be data heavy, right? We have inflation, we have retail sales, we have the beginning, the kickoff of earnings season. And of course, there's going to be a lot of volatility in the markets. We've been seeing a rotation back into the halo trade, which is a topic I covered in my last video last week. And of course, we're paying attention. We're paying attention to all of that and watching the names in the portfolio and the watch list to see which one deserves the backing of our capital, the backing of your capital. So again, join Upside Premium. This is the last week to lock in your lower prices. We're going to be putting on a lot of positions around these earnings, as well as long short equity spreads, for the PMI ideas that I already posted and long-term investments into discounted stocks. I hope you got a lot of value out of this, guys. I know I did a lot of talking, but this is honestly a topic that has me very, very excited. So I'll see you guys in the next one. Make sure to check us out in the links below, and good luck to you.